Hello everyone and welcome to our May investment update. This morning I'm joined by Charlotte Lambeth from Charles Stanley. Hi Charlotte, thanks for coming back on.
Hi, good to see you again.
Thank you. I think the last time you saw us was in October, where we were talking about the various feelings that people have as they go through the investment journey. And at that time we were at, I think we determined capitulation stage. Hopefully today we're not there anymore, and it'll be interesting to get your thoughts as to where we are and what the investment landscape looks like over the coming 6 to 12 months. So I think you've got a couple of slides that you were going to share with us. Are you okay to bring those up?
Yeah, sure. Let me just do some sharing. Right. Okay, can you see that all right?
Can indeed. So obviously we've had some news come out this morning around inflation, so I'm sure you'll talk a little bit about that. But over to you.
Indeed. Well, if I move on to sort of start with a bit of where are we now, perhaps. 2023, as you say, we caught up end of last year, and I was saying maybe actually we're somewhere near the bottom, certainly on the emotional journey, which is connected to the market journey. And actually we started 2023 pretty strongly. The economic data coming through was perhaps better than expected. We'd had resilience in the US, data there. We'd got the China reopening post the sort of changes with their zero COVID policy, and the fact that people saw that as positive and perhaps taking us back to a more open and productive and what have you, China. The mild winter in Europe had been really helpful in protecting particularly big economies like Germany from the worst impacts of the increase in fuel costs that we've been seeing because of the whole Ukraine situation. So overall, we started the year looking pretty strong, and you may remember mid-Feb we were hitting new all-time highs on the FTSE. Perhaps that felt a bit odd given everything that was going on in the world, despite data looking not too bad. And it is worth pointing out that actually, although things came back quite substantially for reasons that we'll talk about in a second, actually we've bounced back quite a bit. We're not too far off those levels even now with everything that's going on, but that's not to say that there aren't issues that we need to be mindful of with that, so I'll come to some of those bits in a second. Interest rates, another key story that we were talking about at the time. Back end of last year, obviously we'd just been through the Truss government and so on, and that had rather affected things in the UK. We are probably at or close to the peak in the US and maybe coming up in the UK. As you say, in inflation numbers today finally coming down, first reading under 9 for over a year, which isn't a sentence that one might have anticipated saying a little while ago. But we could still see a rate rise in June. Possibly, but we're probably close. Whether we're quite there or not, we're probably close in the UK. Eurozone might have a bit further to go. They were a bit slower to get going, and there might be a bit further to go there. One of the interesting things on that, though, is there is a tension around what's going on with interest rates and inflation, because markets are definitely pricing in cuts this year. In the US, somewhere in the 0.75 to 1.25 region. But central banks are very clearly saying no cuts this year. So who's right? Who's going to have actually called what's going on in the inflationary environment best, et cetera, et cetera. So that's definitely one of the tensions that we're facing at the moment.
Just interestingly on, sorry, Charlotte, just interestingly
No.
on interest rates. Obviously last year when we spoke, we were seeing, for example, mortgage rates going up exponentially quickly because there was no understanding as to, where interest rates were going to finish based on what had just happened with Liz Truss and Kwasi Kwarteng. Interestingly, as of the beginning of this week, 2-year fixed rates on mortgages are currently lower than the Bank of England base rate.
Interesting. Well, that's
tells a bit of a story, whether they've got it right or not. But they're obviously assuming that, I presume, definitely towards the back end of this year or next year that interest rates are going to come down, because otherwise they're betting, well, they haven't got much in the way of a spread there, have they? So
no, absolutely, and you're right. Certainly, as I say, there are expectations that interest rates will be coming down. Now, if you look at the UK, that's partially because the MPC and so on are working on predictions that say that theoretically inflation will be down at 3.5% by the end of the year, something like that. Now, from 8% now, yes, fine, it's gone in the right direction. I'm not quite sure that I agree we'll be at those low levels at the year end. Hopefully it will be heading in the right direction though. I'm nervous that because of that we won't actually be seeing the pivot in interest rates, and that may be a bit of a drag on markets. It's certainly an area that's quite opaque at the moment, but I do think as we head into next year, at some point we definitely will be on the right side of things. So if you're looking at slightly longer term things, 2-year fixes, etc., then it may well make sense to them. Certainly a question that we've been asked by some of our bigger corporates, charities, that sort of thing, is if we can be getting the rates that we can on cash, and returns are looking low at the moment on equity, why should we be taking the risk of being in those markets? And it's a valid question. I think the key thing to think about there is around why are you taking the risk, and also why are rates where they are at the moment, and what's going to happen there. So absolutely, if you've got cash that you need to keep as cash, finding a fixed rate sometime at the moment probably looks like quite a good call. I don't think rates are going to be going hugely higher from here. If you can get yourself locked into something, that probably looks quite attractive. But the expectation is that rates will be heading downwards at some point over the next couple of years.
I think the other point you made last time, Charlotte, was that actually you never know when it's going to turn. We obviously have an idea, and we try to predict when we might see things recover. And if you're not in the market at particular times of turning, then you miss out on the pretty quick return.
Absolutely. And what one would expect is that the reasons that would see those interest rates coming back would be really positive for markets and companies and growth. That's all about entering the growth phase of the cycle. So at that stage, you would expect equity markets to begin to perform quite strongly. And, so jumping in and out is incredible. If it was really easy to just get out for the difficult bits and get back on for, we'd all be doing it, clearly.
Absolutely.
I don't pretend that we're that clever. So we have to try and make sure that we are broadly positioned, and that you're never going to get the final bits of the up or the down. And so my perspective is absolutely, for cash that needs to be cash, now's probably quite a good time, if you can get fixed rates and things, to look at it. But I wouldn't be taking money substantially out of the market necessarily at this stage, just because of, oh well, I can get 4% on a cash rate. As long as you're comfortable, as ever, that money that's in the market is money that you can afford to see go up and down a bit, then I think sticking with it is likely to be better when you're taking a sort of 2-year time horizon. So yes, sorry, a little aside there, but it might be relevant.
Absolutely. And I think as you said, really, in terms of interest rates, it's about trying to contain inflation. And obviously we spoke about this just before we came on. The sort of the domestic inflation in the UK currently is still quite high, and the bulk of this drop is down to gas and oil prices reducing over the last 12 months again. So they need to tackle the inflation by keep putting interest rates up for a period of time. And I think one of the statistics you spoke about is at the beginning of this year, only 14% of households had remortgaged. And now by the end of this year, it's anticipated 40% of households that have mortgages will have remortgaged. So the sort of the impact of these interest rate rises haven't really been felt across much of the UK, but certainly will progressively happen throughout this year.
Absolutely, that the pressure slowly increases, and it's the pressure even of those early rate rises, kind of is then cumulative effectively, because more and more people suddenly get affected. So it's the old turning a super tank around, trying to work out exactly how far and you push is very tricky. The central banks have got a difficult job trying to manage things at the moment, and I think it will be hard for them to know when they've done enough, because they really don't want to undershoot. That if anything, I think all of them would be happier overshooting and perhaps triggering a bit of a recession, a bit of a downturn if they absolutely have to. Now, admittedly, we had some numbers out today, IMF saying that actually they think the UK is going to avoid a recession. Certainly, we were thinking that the US might have done the tricky thing and engineered the so-called soft landing. It was much talked about, but very hard to do. It has to be said the whole debt ceiling thing might possibly get in the way of that if they can't come to some agreements over there on that side of things. But the problem with just a slowdown is that it might be easy for some of that sticky inflation to actually hang in there if they don't make sure they really have got it properly under control. And as you say, the number coming down is very much about energy. People will no doubt have heard that the food price inflation still remains really high. I mean, it's over 19% for food inflation. So that is still going to be having a real impact for households. But what we call core inflation, which is basically goods and services, but excluding food and fuel, so those two big items that have been so volatile recently, that's also just holding really steadily high at the moment. It's over 6%. It's been holding there and not coming back. The movements backwards really have been heavily tied to those other areas. So
what's been the driving force on that, do you think?
I think there's a lot of margin pressure. Some of the things, one of the themes I think we perhaps talked about last time, but certainly one of our themes for the next few years that we're looking at is deglobalization, reshoring, that sort of thing.
Okay.
I think COVID and so on made people realize that long supply lines have their own issues, and whether it's the Trump mega cry or just the fact that companies want to be a bit less vulnerable, the impact of Brexit, there's a lot of different drivers around different parts of the world, but that are encouraging people to try and bring things a bit closer to home. But the problems with that is, the reason for the offshoring was to try and reduce costs. So then they've got to try and work out how to handle some of what's going on there. So there's various issues going on. We've seen wage increases coming through again. People have seen numbers, 7% private sector wage increases over the last year. And that means that it kind of embeds inflation a bit if we're not careful. So yeah, at the moment, that's the area that may make it harder for them to be able to turn around on interest rates sooner.
And what might be interesting is probably the last quarter of this year, because what we know from giving advice on mortgages is that on normal years, you have two really peak areas of the year. Sort of April, May time, this time of year when people are coming up for a remortgage. Funny enough, it's where they bought the house a couple of months before. And then the same, September, October. October is one of the biggest months for remortgages. And so I think it will be interesting to see what happens in Q3 and whether we really start to see a much tighter control over people's spending in the latter part of the year, and which is why they may be confident that inflation could drop.
Indeed. And I think, we'll come on to the outlook in a minute, but I think Q3 could potentially be quite an interesting time in markets as well, dependent on how the earnings season goes. Things have held up pretty well so far. Margin pressures and so on have managed to be offset. People working smarter, using the likes of AI, obviously a hot topic at the moment, sort of things like that to try and make their businesses smarter, and lots of pressure to continue to do that sort of thing. But if we do start to see the impact of consumer spending slowing, confidence perhaps waning a bit, if that comes through in Q3, then we might see a bit of a step back and a wobble at that point.
Okay.
I suppose just sort of finishing off on the where are we now, the other thing that has happened was the big dip that we saw in March on the US regional banking episode, shall we call it? It's not a banking crisis, obviously. So that's certainly been interesting, and raised a big question of, are we in 2008 Mark II? I mean, in summary, our view is that we're not, in that we don't think there's a systemic problem with banks across the board. But that's not to say that there might not be ongoing problems in that kind of regional sector in the US. Their banking model looks very different to ours. They've got a lot of citywide, statewide kind of institutions in a way that we don't have. We consolidated ours into big entities over the last century, really, and so it looks quite different. But some of those smaller institutions may struggle during this period if they find they've positioned themselves incorrectly. But at the moment, we don't think that's going to cause a full-scale 2008 style banking crisis again. What I think it will do, though, is provide further tightening in the credit markets, though, because they are quite an important part of providing loans to sort of mid and small businesses in their local areas. And if they're suddenly having to shore up their balance sheets and make sure that they're retaining confidence on that side of things over in America, they won't be lending so much, and that may put a bit more of a squeeze on, in addition to the interest rate rises that the Fed's been implementing. And we may therefore find that actually you've got a bit of a double whammy on reducing capital expenditure and business activity over there. So again, there's a few different adjustments being made to the economy, and it'll be interesting to see how that all pans out.
Brilliant. So where are we going? I guess
where are we going? Well, I suppose one thing I did want to point out was just, I always talk about lies, damn lies, and statistics. I said earlier that market returns actually haven't been too bad, and it's true they haven't. By some metrics they haven't, bearing in mind where we are. But I was just using as an example the S&P, and what I wanted to talk about was the concentration of returns. So year to date, you can argue that the S&P is up about just over 9%, 9.2%. But what does that actually mean, or what does it actually look like? And the reason I put this chart in is just to show quite how concentrated that return really is. You've got 7 stocks there, and you may notice there's a bit of a theme in those stocks, in that they are, in general terms, tech stocks. They took an absolute hammering last year. The rising interest rate environment meant that for growth stocks, suddenly it was not such a pleasant place for them to be. So they were out of favour. There were also various regulatory and taxation issues that were swirling around, which perhaps were causing problems. So they had a really bad year last year, but they have been on a bit of a recovery charge as people see perhaps slowing rates of interest rate increases, peaks on the horizon, etc. That's allowed people to feel more positive. We talked earlier again about AI and the rise of various things. Again, lots of these companies are involved in that, whether it's Microsoft developing it, and involvement with ChatGPT and all of that sort of thing, or Nvidia that makes the chips to make that happen. So again, lots of ways that people can be benefiting from these things. But as you can see, you've got 7 stocks there making up the bulk of that performance. The rest, that's the 493 other stocks in the S&P 500, 0.34%. So it's safe to say it depends a bit what you're in. And from our perspective, I guess what that does mean is we do think that now is a time that there is perhaps more of a place for active management rather than passive management, in that you can try and identify sectors that can do well. Those that are not going to do well may distinctly not. And actually the difference that you can achieve in returns by getting that right could be quite considerable. So just
in terms of this, Charlotte, what's the likely rationale for how come these particular tech companies have done so well in a short space of time? Just before you answer that, I'd probably also suggest that whilst they've increased by 9% quickly, they could also decrease. by 9%
Absolutely.
very
And
quickly
last
with
year
such an amount of concentration.
they decreased much more than that last year in most cases.
Indeed.
So absolutely. You know, that in some ways, I guess that's the point, because it's very concentrated. I mean, you know, you and I, as all our clients will be aware, rabbit on about spreading your risk a lot. Diversification is probably a word that we are quite fond of, I'm sure. And you know, that's because if you are just exposed to a few stocks, then you know, obviously what can go up can go down, etc., etc. Why have they done so well? So I muttered about them being growth companies. Effectively, what we've seen is when you're valuing a company and thinking about whether it makes a good shareholding opportunity, you're thinking about the two types of return that you can get from an equity, and that comes in the form of income through dividends to reward you for taking the risk of being in there, and hopefully it comes in the form of growth in the share price, so capital return, and the two together create the total return for an investment. If you've got a company that pays a decent dividend, you can sort of say, well, all right, it might not do so much on the capital side, but if it's throwing off 3, 4, 5% in dividend each year, I'll perhaps forgive them a bit for being a bit less exciting on the capital side. And, you know, it does its thing, provides a regularity of income that I can see value in. If you're a company that doesn't really throw out much in the way of dividend, and all your return is therefore through growth in the share price, what people need to anticipate when they're trying to work out what the price should be is what the future value is going to be. You know, how much does it need to grow to be attractive versus something that's giving you that income that you could invest in something else or spend or whatever. And when interest rates were very, very low, the income that you could get off something was also very low. So the growth was worth a lot, effectively. You know, that capital value was worth a lot. But if you can get that 4% return on cash, well, hold on a moment, suddenly you've got to grow even more than that to make sense of the risk that I'm taking in being in an equity and not just being in cash. So suddenly all of those models get repriced. And we saw a lot of growth stocks get very heavily impacted by that last year as we hit that tipping point on interest rates. As I say, as we get closer to a point where people think that rates are peaking and that therefore they're not going to go much higher from here, and indeed they might be going down again. So if you're looking 12 months out, 24 months out, actually those interest rates might be lower. Suddenly the growth potentially looks more valuable again. So again, those pricing models get adjusted. So that's a big part of it. The other part of it, again, is perhaps some of the sentiment has turned around. There's a lot of excitement about some of these areas again at the minute. There's new ideas, or perhaps not new ideas, but things sort of coming to market that people are seeing in a new light. You can say that's a bit of a fad or whatever, but sentiment definitely is a key part of market returns. And again, a lot of these are beneficiaries of that sort of thing. So there's a few few things acting there.
Brilliant. Thanks for that.
All right. So yes, there's just a bit of careful what you're looking at, I suppose. So market outlook. It is safe to say that things have probably got more complicated as 2023 has progressed, and right this second the outlook is quite opaque. That would be fair for exactly what the next few months hold. A soft landing in the US is still possible, but there are quite a lot of factors at play, and it does look like it's probably a fairly difficult balancing act for the Fed to engineer. We mentioned briefly the whole debt ceiling situation earlier. This is basically where the government needs to negotiate increasing the cap on spending before they run out of money to pay little things like salaries to all their government employees and the military and pensions and all that kind of stuff, which is at the moment going to happen sometime in early June. Biden's quoting a date of 1st of June. That might be fractionally early, but sometime very early part of June would be when that would happen otherwise. And we've been here before. People may remember that we've been here before. And in general terms, they like to go down to the wire, but normally they do come to an agreement. And the market is certainly telling you that that's what they're expecting at the moment. That they are not pricing in a default at the minute. So if that were to happen, that would have a negative effect on markets. There's no doubt about it. How negative is open to question, and it would depend a bit what would happen. The so-called response would be moving to what they call payment prioritization. And in the first instance, what they would do is actually focus on paying the interest on debt so that they didn't default over and above other things. But that means you then get deeper cuts in other sectors, so pensions, etc., end up more impacted in order to keep paying the interest on bonds to stop a default in the market. The other thing that the Fed could do is reissue or issue new bonds and do kind of swaps where they replace maturing debt with new debt to sort of allow things to roll. But that's only going to be a short-term solution, because obviously people are only going to buy that Kool-Aid for a short period of time before they decide that there might be a bigger problem.
But it's fair to say, isn't it, that it's not really in either party's interest for this not to be resolved. No. But there's probably some political gaming going on as much as anything else. We've obviously been here before through Obama's reign, and you know, hopefully, as you said, if the markets are pricing in the fact that it's not going to default, that suggested that they believe that they will come to an 11th hour deal.
Absolutely, that's the expectation. And I think in some ways politically, I mean, it's tricky. It's a great platform for both sides to try and put forward their views, and we have to bear in mind we're coming into an election year. But equally, I think the Republicans in particular do not want to paint themselves as the bad guys in this. On the one hand, yes, clearly politically they've got a view around the scale of government spending and you know, how that sits in the budget, and not wanting to encourage it to be greater. But equally, at a time of cost of living crisis, etc., they do not want to be seen as being responsible for hardship of millions of just ordinary people purely for political gain. That I don't think they're going to see that as constructive for them at this time. So I think there will be a deal reached, but it could well be pretty 11th hour again, just because the drama provides for more platforming on both sides.
Sure. So the next sort of 6 months, you sort of alluded to earlier, you think when the earnings come out Q3, we might have a little bit of volatility if expectations aren't met. And then the hope that a turn of the year interest rates might be on the turn back down.
Yeah, I think so. I mean, this probably is a bit of a, I mean, not that I would ever actually advocate this exactly, but sell in May and go away from the point of view of your expectations. I think could well be the case, broadly flat for this bit. You know, that there'll be good days and bad days, and clearly, you know, stuff around the debt ceiling and what have you is the sort of news flow that can create movements. But I think as we look back at the summer, we may well find that it hasn't really gone anywhere overall. Q3, as I say, could be interesting dependent on what those earnings show, and may create a little dip. But optimist that I am, I think I would see that as a buying opportunity if we do see a pullback at that stage. I think as we look into 2024, you know, I may be saying that the thoughts of interest rates coming back this year might be a bit over optimistic, but I do think they will in 2024. So at that stage, that will be positive. I think we will see inflation coming back more under control. So that would be positive. So at that stage, I think there's lots of opportunities available. From the point of view of where you'd want to be, you've seen the benefit of you know, some of the growth stocks that got hit really hard by some of this previously. They would have the potential to recover. Obviously, as you move into the right part of the business cycle, more cyclical stocks will also look to do well. I think I would be focusing on quality, but you know, definitely we'd see opportunities there. So the usual kind of, look, this is money that you know can be volatile, so this year it could be a bit uppy downy still, but not, I think, overall terrible, and definitely with the potential for next year to be quite a good one, I would hope.
Fingers and toes crossed. So brilliant. Charlotte, thank you ever so much for your time today. Thanks everyone for listening in, and we will have our next one in a few weeks' time for our, I can't believe I'm saying it, June market update. Thanks everyone. Speak to you soon. See you soon.